Chapter 2, Part 2, the financial statements. Now, the financial statements, we have 4 of them. 3 of them are considered change statements, which they're showing you activity over a period. Whereas one of them, the balance sheet, is considered a point-in-time statement. They seem to differentiate that in the book, so I think it's something I should mention. So, you always start with the income statement, and this will always include revenues and expense accounts. Not any other accounts will go on the income statement, and that's going to report the net income, which then flows into the statement of stockholders' equity. This is going to show the changes in your equity accounts, including common stock, additional paid-in capital, retained earnings. Next, and cumulative other comprehensive income. We're not covering that yet, but we will further on. Then we have the balance sheet. Now, the balance sheet is going to take that ending balance in our retained earnings account, and we're going to create the balance sheet, which is going to report assets, liabilities, and stockholders' equity. The last statement we prepare is the statement of cash flow. This is going to show your source and use of, it's going to explain the change in the cash balance from the beginning of the year. Again, these reflect events that occurred during a period of time. And the balance sheet reflects events that occurred at a point in time. I don't know why they differentiate this. I don't know why it matters. But let's go forward. Okay, we have 2 types of presentations. We have the multi-step or classified income statement, and this is used by manufacturers because it shows you that item called, first you start with sales less sales returns and allowances and sales discounts to get net sales, and in this one you have cost of goods sold. So you get gross profit, selling expenses, administrative expenses, and this gives you operating income. Here we're focusing on the income that's derived from running the operation day to day. Then we have other gains or losses. This is when we sell equipment or investments. If there's a difference between what we paid and what we received, it would go here. Also, we put in things like interest income and interest expense. Then we get income from continuing operations. This is all pre-tax. And then we do income tax expense, and we get our operating income from continuing operations. And then we would adjust for discontinued operations, which are always net of tax. And then we get our net income. And then we have this new category called other comprehensive income. This is derived from things that are outside the normal scope of business. So, it represents changes in stockholders' equity during a period that are not a result of transactions with owners. It can be reported as part of the income statement, but almost all companies show it on a separate statement. So they'll show net income, and then you'll have a page that follows, which starts with net income and then show changes due to other comprehensive income type activity. These are always shown net of tax. Another example would be currency fluctuations. Now, then we have a single step, which is used by a service business. It would look like this. We would include all the revenue together. You'd still do net sales. We would include all the revenue. And then, but we would still isolate out discontinued operation and other comprehensive income. Now we're going to walk through an example. And we're going to start with an adjusted trial balance. And now here's the thing you always want to do when you're preparing financial statements from an adjusted trial balance. Check things off as you use them, because you must use every single item and only once in order for your balance sheet to balance at the end. So we're going to start with our classified and single step income statement, and we're going to look to see what do we include. So We're going to start with sales. We're going to include interest revenue and all of our expense accounts, which includes cost of goods sold. These are what are going to be on the income statement. Now we're going to look at see what that looks like. So, based on the information provided, we're going to have our sales less cost of goods sold. That's how we get our gross profit minus administrative, gives us income from operations, other revenue and expense, income before taxes, income taxes, and net income. This is what it would look like if it was single step. Now we're going to prepare our statement of stockholders' equity. So again, what you want to do is check off all the items that we use, which would include common stock, retained earnings, and dividends. Now this is what that statement would look like. We would start with our beginning balances. Then we would put in our net income, which affects retained earnings. And then we would do our dividends. And that gives us our ending balance. And that, remember, this is always the balance you're going to use when you do the balance sheet, or you won't balance. Okay, when we do the balance sheet, we must break it down between current assets, converted to cash, sold, or consumed in the next year of the operating cycle, whichever is shorter. Long-term assets held for longer than 1 year includes plant assets. And the same, we have current liabilities and then non-current or long-term liabilities. So now we're going to go back to our adjusted trial balance. This again is called a classified balance sheet, and we're going to check off the items that we're going to use, which would be all the rest of the ones that we haven't used so far. But if you notice, by the time I'm done, I have checked off everything on that balance sheet. So remember, this is beginning retained earnings, and it's not the item you use on the balance sheet. Instead, it's the one that's been adjusted for net income less any dividends. Now, the classified balance sheet. We start with our assets, and we divide current. And then we do our non-current or long-term. Less accumulated depreciation. Remember, depreciation is a contra asset account. It must always follow the account it's contra to. So whenever you have a contra account, it must follow the account it's contra to. Now, it's a contra account when it reduces. It's called an adjunct account when it increases. Now we have our total assets. Now we know that our liabilities and equity must equal that number. So we have our current liabilities, which is our total liabilities. We have our equity. And now, if you notice, they both agree. And our balance sheet balances. I'm not going to do a cash flow statement right now because I didn't ask you to do one in the homework, so we'll cover that later on. Again, this must be equal. And again, make sure you use the adjusted retained earnings, not the one that was on the balance sheet. Okay, now what we're going to do is we're going to look at how do you convert cash-based accounting to accrual-based accounting. And remember, cash-based accounting is not GAAP. It produces a measurement called net operating cash flow. So this is actually what we go for when we do the cash flow statement. But what if we start off with the cash basis, cash receipts and disbursements, and we want to go to accrual accounting? So accrual accounting measures an entity's accomplishments and resources sacrificed during the period, regardless of when the cash is received or paid. Now we're going to look at an example. So Mike maintains his books on a cash basis, and during 2020 he received $545,000 in cash for services and spent $412,000 on expenses. In addition, there was depreciation of $22,000, other information on current assets and liabilities, because that's the only thing you would be looking at. Now, what we need to do with this information, we have the beginning of the year balance, the ending year. First thing we need to do is determine when did the accounts go up or down from the beginning of the year. And when we go through that, we see that our accounts receivable went down, our prepaid insurance went up, our prepaid rent went down, our deferred revenue went up, and accounts payable went up. So now what we're going to do is we have to go through, now remember, you now have it on a cash basis. We have to go to accrual accounting. And so what we have to do is go backwards with the rules we normally apply when we're going from accrual to figure out cash from operating activities on the cash flow statement. So, changes in current assets has, if a decrease, it is subtracted, and an increase, it's added. So for current assets, it goes in the same direction. For changes in current liabilities, we have an inverse effect. Therefore, we subtract increases and add decreases. Again, this is the opposite of the cash flow statement because in essence, we're going backwards. So this is what we would look like. Net income on a cash basis would be the cash for services minus the expenses. Now, the accounts receivable went down, so we collected more than we generated. So we have to subtract that out. Prepaid insurance, we purchased more than we used, so we have to add that back in. Prepaid rent, we used more than we paid, so we have to subtract that out. Deferred revenue, we received more than we earned. We have to take that out. Accounts payable, we incurred more than we paid. We have to subtract that out. Other payables didn't change. And then, of course, what we have to do, because we're going to accrual accounting, we have to subtract out depreciation expense. So, accrued net income based on an accrual basis, in this example, would be $99,300. Now, that should help you with your homework. And next, we go to Chapter 3.